We've had seemingly endless conversation here and beyond about Bitcoin's correlation to global markets and what's happening in global markets in general. It poses the question that we have here in the title: can Bitcoin go up when everything looks like shit? I know we went with a very eloquent and classy title for today's panel. So as you guys know, we do this live panel now every single Thursday. I have some incredible guests. Can't wait to dig in. So you guys don't want to miss it. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of Wall Streets. Before we get started, subscribe to the channel and do whatever you want with the like button. I don't know what you guys are doing with your like buttons. It's kind of weird out there, I know, these days. So as I said, guys, there's been a lot of conversation as to what's going to happen with Bitcoin as we see inflation rising, war in Ukraine, and quite a few other macro disturbances. And as usual, I do not like to be the smartest person in the room. I never am, let's be honest. But I like to try to bring on people with much better perspective than myself. We have some very, very special guests today to discuss this and everything else. So first, I'm going to bring on the first couple. I've got Jeff Dorman from Arca and Joshua Frank from the TIE. How are you guys doing today?
Good. Great. Thanks for having us.
Listen, Pierce Crosby from TradingView was supposed to join us and apparently woke up and had absolutely no voice. I was going to make a joke probably about how we looked like a boy band on the thumbnail. And then I was going to make a Crosby, Stills, Nash and Young joke. And now those are all completely out because the band is broken.
Well, we'll do our best to honor him.
Yeah,
I would like to.
I think we'll be able to manage it. And Raoul Pal will be joining in a little while as well. As you guys know, we kind of do rolling guests here. So listen, let's dig right into it. Can Bitcoin go up when everything looks like shit? Jeff, what do you think?
I think it's a two-part answer. I think first, things actually look like shit. And second of all, it absolutely can, because there's absolutely no historical precedent that says it shouldn't. So what I mean by that is, there's basically four economic quadrants, right? The only one that is really, really negative for risk assets is when you have what's called a disinflationary bust, meaning inflation down and growth down. We're not even close to that yet, right? I mean, we have inflation going higher and we still have the economy doing incredibly well, right? You had record GDP in the fourth quarter, record earnings. Yes, all the things that are happening right now are going to weigh on that. And you have, certainly markets are forward looking. So you are going to start seeing earnings projections going down. You're going to start to see GDP projections going down. But we're nowhere close to an environment which is negative for risk assets, which is when the inflation is going down and real rates are still negative 5% if you believe the 7 to 8% inflation. Even if you go to 3 to 4% inflation, you're still looking at negative 1 to 2% real rates. That's not an environment that is bad for risk assets. So first of all, I would argue for the notion that everything looks that bad. Secondly, is even if it is that bad, can Bitcoin, and I guess we'll stay specifically to just Bitcoin, can Bitcoin rally in the face of that? And the answer is absolutely, right? If you look at the history of rate increases, whether it's 2016 to 2018 or 2005 to 2007, markets don't go down at the beginning of rate increases. Markets go down at the end of rate hike cycles, and rate hike cycles generally take about 2 to 3 years. Even as fast as inflation is rising right now, and the Fed backpedaling because they've been wrong for so long and, out there every minute of every day right now trying to talk the market into all these rate hikes, you're still talking about 7 hikes over the course of a year, and probably more like maybe 15 hikes over the course of 3 years. It's at the end of that rate hike cycle when risk assets generally go down, right? We hiked, several hundred basis points from 2016 to 2018, and it was the end when the Fed had gone too far when risk assets went down, right? 2005 to 2008, same thing. We actually crashed in 2008 after the Fed was already lowering rates again. So we're just nowhere close. This is completely unprecedented to see the market basically say, you know what, we're going to front run 3 years of losses in 3 months' time ahead of the first rate hike, right? We haven't even pulled stimulus yet. The Fed is still out there buying. We're talking about out here in California, for instance, we're talking about gas stimulus checks now to lower the price of gas. I mean, the market has basically said, okay, I know where this path is headed, and we're going to front run all of those losses for 3 years ahead of time. And it just doesn't make any sense. Where's the market going to go You have bonds are basically uninvestable, right? This is the worst drawdown on record for fixed income. Bonds are uninvestable. You have half the world now uninvestable, from Russia to Asia to maybe even places like Canada. The money has to go into U.S. equities, U.S. real estate, and crypto. That's where the money's going.
Yeah, I mean, I think it's interesting that you refer to Bitcoin as a risk as opposed to a risk off asset, and I guess that debate is kind of been, I guess, waging for some time. But it is clear that at least Bitcoin now is behaving as a risk asset. I think one thing that's really interesting to note is, the correlation between Bitcoin and other sectors and subsectors and ecosystems within digital assets is like 0.95, like the correlation of daily returns. So it's hyper correlated. I think the thing that's interesting is, is Bitcoin going to behave like a risk on or a risk off asset, I think is the question, right? So, if it behaves risk on, potentially there's a different impact than if it behaves risk off. But I think another thing which is interesting to look at is all of this new capital that's inflowing into the crypto space. I mean, we've seen a number of these public announcements of raises of large traditional institutional investors rolling out crypto funds. The question that I have, and Jeff, being the CIO of one of the most successful crypto funds, can probably provide some clarity here, is like, how much of that is going to be earmarked for alts versus Bitcoin? And how does that kind of change the trajectory of digital asset markets? Like before, when we talked to institutional investors, especially traditional institutional investors, they were all just primarily looking at Bitcoin or doing things like basis trades and things like that. Now, from every conversation I have, they're starting to get deeper and deeper and deeper into the market. And now they're starting to, in some cases benchmark Bitcoin, but in other cases, and I think Arca may do this, benchmark like the Bloomberg Galaxy crypto index and other types of indices in the space. And so my question, I guess, is Bitcoin going to be risk on or risk off? But if it is risk on and people do kind of come into crypto, are people just going to invest in other assets because that's where their capital is now earmarked? And how much do institutions sway the market versus retail? Because right now, retail is just not talking about crypto.
By the way, we have a special guest who just popped in on our last second invite, Mark Yusko.
Hey,
Mark, I'm sure you know Josh and Jeff, so join the conversation. Raoul will be here in a while as well. If you guys don't know Mark, everyone here knows Mark. Come on.
We go way back.
Yeah. So Mark, we're obviously, I posed the question initially right before you signed on backstage, if Bitcoin can go up when everything looks like shit. And now we're debating, I guess, if everything actually looks like shit and if this Bitcoin is in fact a risk on or risk off asset. I think you caught the tail end of what Josh was talking about there.
Yeah.
Yeah.
No, I agree with Josh's comments. Yeah. I think the challenge is the marginal price of Bitcoin today is set by a very small number of tokens and very illiquid on the fringe. So, so much is either lost or stolen, in hodlers' hands. So it's still functioning erratically. And I don't know that you can really intuit very much. And I'm actually kind of amazed. People are trying to look at daily movements and weekly movements and say, oh, it is a safe haven. Oh, well, no, it's not a safe haven. Oh, it's an inflation hedge. Oh, it's not an inflation hedge. Oh, it's good. Oh, it's bad. Come on, guys. If you step back, it's like I heard someone the other day saying, the correlations are really, really high, and it proves it's a risk on asset. I'm like, what correlations? Oh, the rolling 30-day correlations. I'm like,
yeah, exactly.
30-day is not correlation, right? Stop, step back, and zoom out. But anyway.
Yeah, I think over a 10-year period, it's never been more than like 0.16, I think.
Exactly.
So, yeah. Go ahead, Jeff.
Yeah, and zero to bonds. 0.0 to bonds.
I mean, I write about this stuff every week, and it gives me kind of a good historical, look back into what I was talking about at any given time period. And I can tell you that I've written about at least 6 different correlation themes with Bitcoin specifically, right? Whether it's correlated to the dollar or the yuan or, stocks or avocados. I mean, you name it, right? It bounces around. So by definition, if you're talking about all these different correlations, it means it's uncorrelated. So I don't really put much stock into what it's doing right now. What I would say, though, is it's undeniably a risk asset in terms of how it trades, but it doesn't mean it is a risk asset in terms of where we'll be 5 or 10 years from now. So what I care about is I think the day-to-day movements of Bitcoin are almost impossible to predict, and anyone who suggests that they know what's going on is, it's either, broken clock is right twice a day, or just it happens to be in that moment, and that's it, right? So I think of Bitcoin as a long tail option, right? It is a long tail call option, and every movement either towards $1 million per Bitcoin, which is probably where we're headed from a relative value standpoint, to zero, is just a path function on the probabilities of getting to one of those two extremes. And I think it's undeniable that the probability of going to zero has been going down, over and over again over the last, 5 years. And that probability of heading to where fair value is has been going higher. So I think that's why Bitcoin goes higher. But on a day-to-day standpoint, again, you look at any piece of news that's out there, and it's completely, random reactions. Like when you go back to the Iran, missile that was launched in early 2020, Bitcoin went higher, right? It was viewed as a risk-off asset in line with like gold and treasuries. But then you fast forward to Russia bombing Ukraine, and it was the exact opposite. It went lower, right? You could talk about inflation, right? There are times when Bitcoin goes higher on inflationary news, like the first CPI report that was really bad in November. And then you have other inflation reports where Bitcoin trades down, right? So on a day-to-day basis or a week-to-week basis, the reactions are just not consistent, right? They're fun to write stories about, but again, if you look back week over week or month over month or year over year, the stories change all the time, which basically tells you that Bitcoin is uncorrelated, and any short-term correlation is spurious at best.
But I want one point on that, and again, Jeff's right as always, but the issue is it's not Bitcoin. Bitcoin has nothing to do, meaning the asset has nothing to do with this.
Right.
It's who holds the asset. And the holders, the marginal holders of this asset, I hate to say it this way, but are crappy holders. They're leveraged speculators and degenerate gamblers that have no interest in the value of the network, have no interest in the use case of the protocol. All they care about is number go up. And when you only care about number go up and you treat it like a meme stock and you lever it, then of course, any sort of bad news in the marketplace and you're going to get a margin call. And, it frustrates me that this very small, because it is very small, number of truly degenerate gamblers are confusing the general population who's trying to understand why this protocol matters, why it is the future of money, why it is the future of value transactions, why it is the base layer protocol.
Do you think
for
that their influence is increasing or decreasing, though, from that perspective? Because one thing, so we have geographic data on social media conversations, and one thing that I find extremely interesting is while Bitcoin and Bitcoin remains the most discussed asset in Western countries, that is really not the case outside of the West. Like if you look at Singapore and other places in Asia, it is completely marginal, and it's becoming marginal. And I wonder if the speculation, the question I'd posed earlier was, alts versus Bitcoin. And I think that's an important conversation in context of institutional allocations at this point. Like, I guess, how much we think like, BitMEX BitMEX still exists, but it's not the same BitMEX that we had in 2017, 2018, like how much influence that still has, or how much like Bitcoin moving to 43 is just Do Kwon and Terra, needing to buy Bitcoin. Right. So like, I don't know.
The other question I want to ask there is like, we also have the aspect that Bitcoin's the only asset that's trading 24/7 and people need liquidity. When you're panicking on Saturday at 9 a.m., you can't sell your Tesla stock. Right. And so to me, that actually maybe affects it even more than necessarily how much leverage there is. But Jeff, I'd love to hear your thoughts. Sorry.
Yeah, I'm glad Josh brought us back to like what the investors are thinking here, because we spend a ton of time talking to pensions and endowments and sovereign wealth funds and multifamily offices. As I said, I know Mark does as well. There's a couple things there with regard to the attitudes there. So first and foremost, everybody at this point understands, at least on the surface, what Bitcoin is, what it's trying to be, what it historically has been, et cetera, right? Whether or not allocations are coming into Bitcoin or not is generally from where the bigger, stickier money is coming from. They're not even looking at the day-to-day. This is a longer term. Do they believe in this as being gold or being a real, technology for medium of exchange or not? And The day-to-day fluctuations are not bothering them. What is different now with the conversations is that 2-3 year funds would be like, can I get Bitcoin exposure? And we would say, well, not really. That's not what we do. We own a little Bitcoin, but it's a very small percentage of our fund. We're looking at all these different assets. And they're like, okay, I get it. But am I getting Bitcoin like exposure? Right? That was the question. Now they're coming to us specifically and saying, I already have my Bitcoin exposure, or I already have my view on Bitcoin. What else can I get? What else is out there? And they're starting to understand the difference between an individual issuer of a token versus a government issuer versus a corporation issuing. They're starting to understand the difference between fully decentralized and fully centralized. They're starting to look at different token types, from asset-backed tokens to pass-through tokens to currencies to different sectors, from DeFi to NFTs to gaming to Web3. And these are questions that we're getting now that are much more sophisticated than before. And we'll go an hour, 2-3 hours sometimes talking in these big groups with 10, 12 people, where inevitably one person comes in as a total naysayer and is just waiting to jump on everything you say as a gotcha moment. One person comes in as a pure believer, trying to convince everyone else in the room, and that's why they got us in the meeting in the first place. And everyone else is kind of just trying to learn on the fly. And inevitably, we'll go 2-3 hours and not even talk about Bitcoin, because it's just like, that's not what they're there for. It doesn't mean they're not allocated to Bitcoin. It doesn't mean they're not interested in it. It's just that they already get that story. They're trying to learn the other stories now. So when you're asking, like, where is the money coming in? Inevitably, the money will also come into Bitcoin. It's just not the only on-ramp like it used to be. It used to be anybody who's in digital assets, no matter what, they started with Bitcoin. That was the first thing they knew about. That was the first thing they bought. Now people are coming in directly through NFTs. They're coming in directly through stable coins. They're coming in directly through liquid funds like what we run. And as a result, yeah, that's absolutely going to put upward pressure on other assets, probably relatively to Bitcoin, just because Bitcoin is so much bigger than the other ones. But it doesn't necessarily, and I don't even use the word alts. You started this like Bitcoin versus alts. Like, I think alts is just an awful term at this point, right? Because it's suggesting that everything is not Bitcoin, is something homogenous. And obviously we know now that there's absolutely no, similarities to something like BNB compared to something like, Wi-Fi compared to something like, helium. Like, these are all completely different assets. So they are getting more sophisticated. They are looking at all these things, but they also recognize that, the ownership, as Mark was talking about, the ownership of Bitcoin has changed, right? It went from crypto native people only to now every single macro fund, every single quant fund. To Scott's point, yes, it's the only thing open on a Saturday at noon. And if you need to change risk, you're going to use Bitcoin because it's big and it's liquid and it's open. So as Mark said, the investor base has changed. The asset itself has not changed. And right now, that investor base is using Bitcoin like a 24/7 VIX. And that won't be forever, but that's what it's being used for right now. Whereas the other assets are more like, hey, I either made money already or missed on a bunch of technology stocks. I'm not going to miss that again on Web3 and DeFi and gaming. And that's where their focus is.
Fidelity had that incredible report a few weeks ago. I believe it was called Bitcoin First. And basically they sort of illustrated that point. They said there's Bitcoin and then everything else is a venture capital investment in new tech. Right. I'm not saying that it's fair to basket them like that, but I think we have gotten to the point where there's sort of Bitcoin and then everything else is splitting itself into categories.
But I think it's important to recognize with that, though. I think it's important to recognize, yes, Bitcoin is totally different than everything else. So you should put Bitcoin on a pedestal. You should put it differently than everything else. But you shouldn't lump everything else together as one homogenous.
I agree.
I think that's the difference, right?
Yeah.
So I think, yes, Bitcoin is different, but also the other assets are very different as well. And you need to recognize that.
Yeah, and I would go further in that it's too simplistic to say Bitcoin and everything else. I talk about it in the same way as the internet, and it's not perfectly right, but it's closing in on more and more right, which is, the internet, there used to be 80 protocols. Literally, there were 80 different protocols from the 60s, the 70s, the 80s. Today, there are 5 that matter. You got TCP/IP, which we're using right now to talk to one another. We got FTP to move files. We got HTTP to move emails. We got HTTP to do websites. We got SMTP to move emails. And we got www that ties everything together. I will argue that Bitcoin is the base layer, like TCP/IP. Filecoin replaces FTP. Then you got Ethereum at the top, like www ties everything together. It's basically a workshop, so to speak. And then in the middle, you got 3 or 4 competing for who's going to be HTTP, who's going to be SMTP. and that's Polkadot, Cosmos, Solana, and Avalanche. You probably throw a couple other ones in there, but BNB could be in there. Then you got a whole bunch of utility tokens that are just crowdsourced venture capital. To Jeff's point, that's not a bad thing, but remember, pre-seed and seed stage venture capital has roughly a 95% loss ratio, and I don't mean you lose 95. I mean you literally go to zero, and so the expectation is 95% of the thousands of tokens will go to zero. And, it's like all these dog freaking coins, right? Dogecoin and Shiba, they will go to zero. There's no question they will go to zero.
Yeah.
It's
I was
just
going to say there's 95% will go to zero, but we can tell 90% of those. Like literally outright, you can just look down the risk curve and see the name of the coin and know which ones are definitely going there.
But that doesn't mean you can make a lot of money and have a lot of fun along the way, though.
And that's part of the problem, right? Is what's your goal, right? Is your goal to be a long-term investor, to be a trader, to be a degenerate gambler? And I'm fine if the gamblers want to gamble. That's totally fine. But the thing that gets me,
gamblers are a good thing, right? I mean, you need liquid markets. I think gambling and speculation, begets liquidity. Which
speculators are fine. Gamblers are different. Speculators provide that liquidity, Josh. To me, the problem is the gamblers don't really understand what they're doing. They don't understand that the house always wins. They don't understand that on average they will.
And by gambling, you mean somebody using 10x plus leverage, basically.
Yeah, right? yeah. And it's the people that. But then the real problem for me is then media and influencers, social media, pull the unknowing or the wary in to the wrong things at the wrong time, and those people get crushed. Yeah, right.
Well,
when Elon goes on Saturday Night Live and talks about Dogecoin at 69 cents,
even though he says nothing about crypto, called me before that.
A whole bunch of people bought that thing, and now they have a fraction, and they keep. And here's the problem: the difference between investors and traders is investors, a portion of them, are traders where the trade went wrong. Oh, now I'm a long-term investor. Well, now you're just going to lose your money.
Passionate community member.
So something really
this is really important what Mark just said, because I think the media is doing the biggest disservice to investors and this industry. And here's why, for two reasons, right? Let's take AMC and GameStop, for example. If every single new equity investor, the only thing they ever heard about was AMC and GameStop, they would say, well, I'm never investing in the equity market. This is crazy. Those are completely, make no sense why those two are going higher. If that's representative of the entire equity market, then I'm never investing in equities. It's a joke. But we don't do that, right? Because people know about the equity market and they're able to compartmentalize that, hey, AMC and GameStop are these weird sideshows. It's not representative of everything. It's interesting. I might read a Matt Levine story about it, but it's not representative of the entire equity market. But here we are in digital assets, and 95% of the stories are Bitcoin and Dogecoin and Shiba. And it's like, guess what? Those are 3 out of tens of thousands of tokens that are really hard, if not impossible, to value. And it's mostly based on memes. Even Bitcoin, which is the greatest meme token ever, but Bitcoin is largely a meme, right? It is worth what people think it is worth. So if everybody's starting point in digital assets is, oh, all I ever heard about was Dogecoin and Shiba and Ripple, you'd be like, well, I'm never investing in digital assets because these make no sense. And they're dismissing all the things that have real properties and real cash flows and real yields and things that are real. And even worse, so your starting point is just wrong for the most people who get into digital assets. And that's a problem right off the bat. Secondly, it's the way they communicate it. They're like, oh, well, crypto is up today or crypto is down today. I'm like,
I started to drop the bomb and then leave, but I'll leave you guys to sort it out. Scott, thanks for the invite. I got to go inculcate the next generation of coiners. Talking to teaching a university class. Love it. I love that there are classes at university focused on this stuff. Now, see if I can brainwash them. All right, take care, guys.
Thanks, Mark.
So here's what let me just finish real quick. So when the media says crypto is up or crypto is down, right? It makes no sense, right? Like if you think of digital assets as a technology no different than the ETF, right? The first ETF was SPY, the spiders. And now there's there's thousands of ETFs. They can have an ETF for bonds, an ETF for gold, other commodities, fixed income, different sectors, healthcare, finance, etc. You would never be like, oh, ETFs are up or down today, because someone would look at you and be like, well, that's crazy. What are you talking about? Which ETFs are up or down, right? That's essentially what the media does with digital assets. Like, oh, digital assets are up today. What? Which ones are?
Well, I mean,
are
the correlation between these sectors within this market is incredibly high.
It's not true on a day-to-day basis, maybe, but look at the dispersion over the last year. DeFi is down 80%. Gaming NFTs are up 5,000%. Protocols are up 500%. Bitcoin's flat. Like, that's massive dispersion. You can't just say.
Sure, but I would say on the downside. Sorry, so to clarify, on the downside, right? When crypto has a down day, I think there's a lot less dispersion than on an up day.
But that's true in any asset class. Right?
I was going to say that risk off is risk off, right? And that's when everything goes to one.
What I would add on the meme stock thing, and I have to hop as well in a second. We've actually done a ton of research on pricing of digital assets, which is kind of related to the impact of retail. And we found that assets priced below 5 cents over the last year and a half outperformed assets above $10 by 1,500% for nothing other than price, even if you stratify it by different levels of market cap, which kind of shows this kind of retail mindset and mentality. And if you ever spend 5 seconds on TikTok, crypto TikTok, which is an interesting and very unique place, you'll see it, right? Where a retail investor goes, hey, this asset is a tenth of a penny. If I put $100 in and it goes to $1, I'm going to become a billionaire. And I think that's still a very significant part of digital asset markets. And we see that reflected in the assets that are outperforming generally tend to be like, you mentioned Wi-Fi and other expensive assets, like, assets that are higher priced for obviously we know that market cap is what theoretically should matter, but actually the pricing of these assets seems to have a very, very significant impact as well.
That makes sense. I think it's just really important to differentiate. We say gamblers, and thank you, Josh, and Raoul will be here momentarily, Jeff. But you say gamblers and speculators. I think the problem is bigger than that. It's gamblers who don't understand that they're gambling. To your point about the media, correct? It's people who buy these assets and think that they're long-term investments and literally have no idea what they're investing in.
Yeah, I mean, I don't even have a problem with that in the sense that that's the best way to learn, right? I mean, there's no investor in the world who hasn't gotten their ass handed to them at some point and has learned a ton from that. I think it's if you go all in and you lose everything and you can't come back, that's a problem. But you got to learn somewhere. And generally, people aren't going to start on day one and be like, what I'm going to do is I'm going to rip through a white paper and learn everything about the tokenomics, or I'm going to look at every piece of the inflation schedule, the amortization schedule, understand exactly what it is. Usually they buy something because a friend told them to, and then if they are interested in it, it'll lead them into the Discord or the Telegram group or Twitter and somewhere where they learn more. And if you lose a little bit of money along the way, treat it like education. If you're going to spend a couple $100,000 on a college education, you should be willing to spend $5,000 or $10,000 on learning about digital assets. So the speculating and the guessing and not really understanding what you're doing, I don't have a problem with that if you learn from it. It's when you don't learn from it and you're just doing it because you think you're a genius because it went up for a little bit. That's where it becomes a problem. But I think everybody learns more by doing than they do by reading or listening. And if that means that leads to a lot of people buying something like a Ripple or a Cardano or a Dogecoin or a Shiba, so be it, right? I think generally those will be painful lessons. Sometimes you'll make a lot of money on those, but generally those will be painful lessons. And you'll learn, okay, what did I do right? What did I do wrong? And what else is out there? When I mentioned earlier that Bitcoin used to be everybody's stepping stone, now it's not. Like, I don't think that's necessarily a bad thing. I think it's good that people are coming into this market through different channels. Eventually, they're going to own Bitcoin. Everyone eventually does. But it's good that Bitcoin's not the only starting point anymore. It's good that people are coming in from different channels and are getting different exposures and learning about it. Like I said, I don't have a problem with the retail investor or the gambler or even the exchanges listing a bunch of random stuff. I really think it's the narrative that is coming from the media for the most part that is the most damaging. It is this, this Bitcoin versus alts, or this, overly focus on these, one or two random coins. I think it's really damaging. It makes people think that this market is much different than it actually is. There needs to be a little bit more level of sophistication in terms of what the mainstream financial media talks about. And I'll give you an example. I spoke to someone from the Wall Street. I spoke to someone from the Wall Street Journal yesterday for about 45 minutes, and the question was about Tether and shorting Tether. And we spent 30 seconds on that, and we spent 44 minutes going over like the taxonomy of digital assets. And this is a very knowledgeable, very senior Wall Street Journal financial reporter, and literally didn't even know what DeFi was or what, gaming tokens were. And I'm just like, that's the education that we have to do out there is get them to write stories about these different sectors and these different token types, and not just, oh, Dogecoin went up today, or fir tree is shorting Tether.
Yeah, guys, want to welcome Raoul. I think you all know him probably by now.
Morning, gang. How are you?
Good. So we just had Mark Yusko and Josh Frank just left, so you came in at a perfect time. I don't know if you were listening in, but obviously we were sort of having a conversation at the moment about how the mainstream media is somewhat falsely portrayed the crypto market and seems to be driving the narrative that Jeff basically said Bitcoin, Doge, and SHIB, and that's what you hear about. I'm curious your thoughts.
Yes and no, but it changes at the margin, right? If you to go back 2 years and look at the narrative, then a year ago, then now, then to Goldman Sachs's homepage being about digital assets, the world is waking up. As Jeff said, is a lot of the journalists are behind and they're forced to write stories because crypto is engaging. And so they come at it with not enough knowledge yet. But, over time, I'm seeing more and more people getting a little more comfortable with the space. But journalists have this habit of always wanting to find a balance to a story. So that they use the FUD, even though most of it is completely wrong, as their balance, as opposed to writing something more nuanced. And I think that's the issue. But over time, at the margin, it's changing.
And the FUD is rolling, right? I mean, last year it was energy and China, etc. Now it's sanctions or choose what you want. But why does it always have to be some sort of?
Because if you go back and think where narratives come from, they don't come from nowhere. So where did the narrative about energy use come from? Because obviously it's ludicrous. I think if everybody put on their kettle at the same time, we'd use more energy around the world than crypto mining, right? So Bitcoin mining. It actually came, I believe, from the ECB or within the European institutions because they wanted to slow adoption. And they've got an ESG mandate. So if they knew it would bump up against that ESG mandate, they could slow adoption. And they're not trying to slow adoption necessarily to stop it, but just to buy them time to figure stuff out because they're feeling like they're out of control of a situation that's moving too fast. So that's what they're doing. And now sanctions is another way, they're going to use this for bad gains. What they're trying to do is please stop adopting it. But meanwhile, when you go to Wall Street, they're adopting it really fast now. Having spent a lot of time in that world and still speaking to a lot of people, whether it's the giant asset management firms, whether it's the giant pension schemes or the investment banks themselves. So basically, those guys don't make a move without the regulators giving them the nod saying it's fine.
Of course. Yeah.
It's just tactics. It's tactics in a situation where technology is going so fast that they don't know how to keep up with it. Because, they still haven't regulated, they still haven't ruled on bloody Ripple. And what are they going to do with all of the DAOs, all of the NFTs, the social tokens? They're so far behind that they're going to have to draw the line somewhere. Because what are they going to do? Just keep fining everybody, give them a slap on the wrist and letting them move forward? And this goes on in perpetuity? I get it. It's a tax. So they're going to do that a bit. And that's fine. That's the cost of doing business in the end. Everybody in the space kind of understands that. But at some point, they have to draw the line.
Jeff, what do you think?
I think, well, I'm going to go back to, I don't know if this is 100% where we needed to go next, but I'm going to take one thing that Raoul said. And by the way, welcome, Raoul. Good to talk to you again, my man.
Good to see you,
I think how the narratives get set is really important because we're seeing entrants from everywhere right now, right? Whether it's Citadel saying they're going to make markets, or PIMCO and BlackRock saying that they're getting pressure to start investing, or it's new custody from BNY. And we know the entrants are coming. We know the investors are coming. We know the service providers are coming. The banks and brokers, they're all coming, right? And I didn't even realize that Goldman on their homepage is now talking about digital assets. That's awesome, right? And obviously you're seeing reports from the second and third tier guys like your BTIGs to now JP Morgans and Morgan Stanleys. Like, it's all coming. But the most important narrative right now that I think that is going to lead to the biggest aha moment, as well as like everyone saying in retrospect that was obvious, is what happened in the last 6 weeks with regard to Canada basically freezing out their own citizens. Russia, basically, a small group of oligarchs basically deciding that they were fine just tanking their currency and their economy, to the U.S. and Europe and the sanctions through SWIFT, to even what happened on the London Metals Exchange, right? The LME just flat out canceling a bunch of positive P&L on shorts in nickel. What you're basically saying is the world is now waking up to the fact that what you thought were your assets are not your assets. Well, your assets are somebody else's liability, and whether or not they pay off that liability is now in question, right? Whether or not your government, your bank, your exchange, your brokerage, whether or not they actually release those assets to you is now in question. And that is going to be the biggest driving narrative of the adoption of bearer assets and digital assets that we've ever seen. And I really believe that there is a very good chance that when ETH is at 10,000 and Bitcoin's at 200,000 in maybe as soon as like 12 months, you're going to look back and say, well, yeah, based on what happened in January and February of 2022, that was obvious.
I mean, Jeff, the reason I got into Bitcoin originally back in 2012, 13 was Cyprus. It was exactly the same. They took the entire savings out of the banks and said it's ours now. And I realized that we didn't own anything. So, yeah, what happened after Cyprus obviously was a huge run in crypto for the same reasons. And I think you're dead right.
Yeah. So I think that narrative is really going to start sweeping in. And right now it's a footnote rather than the story, right? And I'm forgetting the guy's name, but the strategist at Credit Suisse who just wrote that, Bretton Woods.
Zoltan,
yeah. Bitcoin was literally a footnote at the bottom of the article, right? It was like 4 or 5 pages all about what money means, and Bretton Woods 1, 2, and now 3. And it was like, I think the line was, if Bitcoin still exists, it'll be bullish for Bitcoin, right? And it was like a little tongue in cheek. It's going from a footnote to the main event. And we're feeling it with the amount of inbound interest we're getting from investors. We're feeling it in terms of the conversations we're having with investors. Again, the pressure that the non-crypto native asset managers are feeling, from your BlackRocks to your PIMCOs, to offer products. It is bubbling, and it may not be explicit yet, where it's like this is an obvious moment to get in, but it's going to be, in retrospect, an obvious turning point. Like, I really believe we'll be pointing to February 2022 for decades to come.
And also, I think there's the other thing at the same time that's come, which was the shift from using crypto and digital assets to this soft term of Web3. It's much easier for regulators to say, of course we should upgrade to Web3. If we're on Web2 now and Web3 is better, we should do it. It doesn't have the word currency in it, which was the big toxic word. And so I think that creates a decent Trojan horse as well, to make it easier for people, the regulators or the politicians particularly, to say, yes, we need to be pioneers in Web3, as opposed to we need to be building cryptocurrencies. So I think those two things, the narrative, which is, as you said, the core case of why these digital assets really matter, plus this new kind of fancy dressing for it all, I think this is a very significant moment.
Well, Jeff, you said before that you dislike the term altcoins. I think the word cryptocurrency is even worse, to Raul's point, right? Because 99% of these are not even attempting to be currencies. Not only are they not currencies, they've never even claimed to be such. It's really a horrible term, I think, for people's first intro or understanding of the asset class.
Oh, 100%. I almost always, in fact, I've probably used the word crypto more on this podcast than I've ever done, in the sense that, or on this show, than I've ever done. Like, I usually just use the word digital assets, because I think, we actually built a taxonomy at Arca. If you go on our website at ar.ca and you look at our resources section, we built a taxonomy because nobody else has done it, right? In the equity and debt world, that's everywhere, whether it's from the rating agencies or from, different independent research reports. Messari is probably the closest in the digital asset world to have built a taxonomy, at least by sector. But we had to start from the top. We were like, let's think of this like fixed income, right? In fixed income, you have different issuer types, right? You have corporations, you've got govies, munis, you have different asset types, you have different sectors, you have different callability structures, different covenants. The same thing is true in digital assets, right? You have different issuer types. You can have an individual issuer, a corporation, a decentralized autonomous organization, et cetera. You can have different spectrums from decentralized to centralized. You can have different token types, all these things I mentioned half an hour ago. Building that taxonomy is really important. And when you do, you realize that cryptocurrency is a very small sliver of what is happening in digital assets. Like I'm not even sure digital assets are an asset class anymore. I used to be 3 years ago. I thought this was an asset class. I don't think it's an asset class anymore. I think it's a technology that now underpins all asset classes, because I think every equity is going to be represented as a token. I think every fixed income instrument is going to be represented as a token. Real estate, commodities, hard assets, you name it. Anything that can be owned is going to be represented in digital asset form at some point. And then we start to look at, this is why I used the ETF analogy earlier. You start to look at this like ETFs, right? It is just a place, it's just a packaging that can package any asset, right? ETFs can have fixed income, commodities, real estate, equities. That's the same thing as a blockchain-based asset. So as soon as we recognize that a cryptocurrency is just a very small sliver of what this package now offers, it starts to recognize, okay, well, that means we can't even think about valuing digital assets all the same. Each type of digital asset needs to be analyzed differently. Just like, Frank Fabozzi came out with the fixed income handbook on how to value fixed income, and Graham and Dodd came out with the valuations and equities, and it's all just adopted now. That same thing is going to be true in digital assets. You're going to have different ways to value protocols. Shout out to one of my best analysts, Nick Holtz, who wrote an awesome blog a few weeks ago saying, our blockchains, should we be valuing them as businesses using like using the cash flow from fees, or should we value them like nations? That they're basically these ecosystems that have their own native currency inside of them. Like, that's the kind of valuation techniques that we need to develop. You're going to value a DeFi or a CeFi token purely based on financial cash flows. You're going to value a Web3 token totally different, based on Metcalfe's law and based on adoption, which is very different than how you might value a layer one protocol, which again is either based on cash flows from a business or through its own native economy, like a nation. So once we start to separate this out, the term cryptocurrency just goes away, right? And it's going to be hard because it's so entrenched in people's minds. But I think a cryptocurrency is just going to be a sliver of what we're ultimately talking about and looking at in this industry.
Doesn't that mean that the technology can succeed without most of the coins that we see now succeeding? Right? It becomes this underlying layer or infrastructure for all of this technology of the future, but that has nothing to do with the individual coins necessarily that exist now.
It depends.
Oh,
I mean,
sure.
What we're seeing is the market figuring out that it's no longer good enough just to be faster, cheaper, alternative to Ethereum or whatever it may be, or more private than Bitcoin. What people are starting to see, and I've been definitely having conversations with people at the protocol layer talking about, okay, what can we be known for on this chain? So people are going to split down to use cases, I think. So if you're really fast and you're not super decentralized and you're very cheap, then you're very useful for the securities industry because they have massive volume and they don't care about decentralization at the level of which private money does. So there's whole different people. I think music industry splits one way. Different application tiers will use for different things. Real estate, they all have different functions. So there's still a lot of space for this broad number of tokens. Obviously, a bunch of this stuff is never going to gain network adoption. That's fine. It's just the same as a VC portfolio where you understand that a bunch of these firms just won't get traction, and that's okay.
Yeah, I mean, I want to go, Raoul and I had the pleasure of talking a few weeks ago as well. And he said something that blew my mind. And I like to think of myself as the king of analogies, because I try really hard to bring everything back to what my, 73-year-old parents would understand and mainstream kind of, this is how digital assets compare to other things. And I've been a long believer that what exists today in digital assets is awesome. There's a lot of really cool projects and ideas and companies that are awesome and are going to, withstand the test of time and be worth, probably trillions of dollars. Certainly Bitcoin and Ethereum fall in that camp, and I think there'll be others as well. But also, we haven't even scratched the surface in terms of the type of token issuers we're going to see. Right? I really believe that digital asset is now part of the capital structure. You're going to have your equity, which is your fund cash flows, your debt, which is your claim on assets, and you're going to have your token, which is a claim on network effect and customers. And we barely have any corporate issuers at all. There's things like Binance and FTX who have issued tokens, but we haven't seen anything close to corporations issuing tokens. I also think every municipality is going to have a token, right? We're not going to see revenue bonds and general obligation bonds anymore. You're going to have a token specific to build a park or a subway system. I think every university is going to have a token. You're going to see Notre Dame coin and Stanford coin and Harvard coin, and you have a kid and you buy that token for them the day they're born, and if they don't go to school there when they're 18, then they trade that token for another token for tuition. I think the type of issuers of digital assets, we haven't even scratched the surface yet. There's going to be so many different token types, and what Raoul said to me blew my mind. He said, "Wait till Disney realizes that a Disney token is going to be multiples more market cap than Disney equity." And I thought about what he's saying, and I'm just like, it is so true. I mean, Disney stock has a market cap of and I'm sure it's in the hundreds of billions, but it's true. I mean, if you introduce a Disney token and that Disney token gives you discounts on, the park access, or maybe you get like the fast pass to get into line at the park differently if you own the token, and not to mention the subscriber benefits of Disney Plus and merchandising and all the other things. He's absolutely right. A Disney token would be 5 to 10x as large as their current market cap. Or even their enterprise value when you include all their debt and equity. And when these companies start to realize that, and when the investment banks start to realize that they should be pitching tokens rather than just debt and equity, case in point, I think it was a couple of years ago that it was either United or Delta was like, hey, we're the worst industry in the world. We go bankrupt every 7 years. We encumber every asset we have with debt. Oh, we can now issue debt against our miles. Let's do that. That's a great idea. And I'm like, what are you doing? This is, your miles, your Delta miles and your United miles is the most perfect thing to be tokenizing. Yet you're just thinking, let's go add more debt to our balance sheet and issue debt backed by our miles. I'm like, this is crazy. Like, why is there nobody innovative pitching these companies on how to issue a token? Now, granted, part of it is because of regulation here in the US, certainly, but that's where we're headed. We're headed in a direction where every company has a token, and that means that's a marginal token today. Good.
And brand is undervalued as an intangible on the balance sheet. So what you're going to do is turn brand, and brand is community and network, into a tangible. So what the hell are all of these companies going to be worth? I saw some report there's like $43 trillion in the S&P 500 in intangibles. And all of this comes tangible. I mean, it's a complete revolution. And what I think the key concept that you get out of it is, if you're a 12-year-old today, you are unlikely to need to work for a company.
Or go to college.
Or go to college, because you can actually participate in these cultural communities of which you are both a network participant and a network kind of motivator and activator, and you get tokens. And therefore, you create universal basic equity. You're taking an equity stake in the cultural communities that you're part of, be that Disney, be it the favorite music artist, be it gaming. That is an incredible difference. So you're doing community work for income or assets. And that solves a lot of the problems that technology is creating, where technology, AI, robotics, eating the world. Well, we create something different. And I kind of like it. It also creates a very different community. If you're on Twitter, it's a toxic cesspool of people insulting you all day and a bunch of really nice people trying to learn from each other. And it's really difficult. But when in a token world, what happens is, if you want your community to thrive and your token to therefore maintain value or increase in value, you're going to only encourage certain types of behavior. And generally, good behavior is going to be rewarded by the community. So you're going to change the nature, because we all are overwhelmed by social media and what it means to us and how complex it is to have everybody shouting at us all day. But when you go to an environment where it's driven by the token, it changes. You see that in Discord channels. People aren't mean to each other. They're just enthusiastic because they're all incentivized by the same thing. So there's a huge change coming here that's going to solve a lot of problems.
We wrote a white paper maybe 5-6 months ago, and we said not ESG, it should be GSE, and the focus on like Bitcoin and its environmental impact was so damaging. And right, obviously there's a lot of nuances to whether or not that's true or not, but regardless, like, it was all focused on the E in ESG. Nobody was focused on the S and the G, which is really all digital assets is accomplishing. the societal benefits and the governance benefits of digital assets is something that we've never seen before. And it's incredibly powerful because of those incentives that Raoul's talking about. And if you look at, let's take the societal aspect for a second. And I talk about this all the time. So those who have heard me, apologize for being repetitive. But if you look at some of the biggest companies and success stories in the world, where the equity holders benefited at the expense of the customers, right? Whether it's McDonald's, right? McDonald's shareholders are almost never the same as the McDonald's customers. Whether it's the newcomers like Airbnb or DoorDash, where regular people made those companies work, but only a handful of VCs made all the money on the stock. Or even something like Amazon, right? Where you could be an Amazon Prime member, which is basically being a network member, without necessarily being an Amazon shareholder, which is the ones who benefit from the growth of that. Well, what tokens are doing is they're combining that. They're saying there is no such thing now as customer versus shareholder. You're all the same people. You're in the network and you're part of it. You're going to own tokens and you're going to benefit from the financial upside as well as from the network benefits. And when you think about what that does from a societal impact, it's probably the most positive development we've ever seen from wealth equality, right? You no longer have to be an elite to make money, right? Everyone always talks about you have to have money to make money. Well, that's not true anymore. Here, go be the first, gamer on a new game and earn some tokens. Go be the first user of a DeFi application and farm for some tokens. You now don't have to come in with money to make money. You can be an active participant and be rewarded for what you're doing. And now let's go back 15 years ago when Facebook was started. It's very famous. It's a very famous story now that Facebook figured out growth hacking before anyone else. They realized through data that if you could get an early user of Facebook to like 10 posts and to follow 10 people within the first week, that they were going to be very sticky customers. So Facebook did everything they could to trick people into doing those actions. Well, digital assets is doing the same thing, only instead of tricking you, they're paying you for those actions. They're saying, if you do the things we want you to do, we're going to give you a piece of our upside. That is incredibly, incredibly powerful. It puts all of the growth back into the hands of the people who make the growth possible. So when you focus on that societal benefit, not to mention the governance, which we didn't even talk about, the ability to actually have a voice, digital assets is the most powerful instrument we've ever seen in terms of capital formation, network effect, evangelism, and equality. And once these companies figure that out, again, it's not going back, right? It's just a matter of how fast we can get a regulatory framework to allow for this. And then to back to 15 minutes ago, the question about like the current crop of tokens versus what's coming, some of the current crop of tokens are still going to be amazing and powerful, but others are going to be a blip relative to Disney token or, Delta token or, a California token or Duke token, right? I mean, like, this is where we're headed. And I think it's this industry is going to be, we talk about, 5-10 trillion. I mean, this could be hundreds of trillions when you talk about all the different, wealth effects that are going to come from this.
And you guys are blowing my mind. People are saying it in the chat, but I mean, that vision is incredible. The question, Raoul, when we've talked in the past, you've always sort of believed that we would have a much more accelerated timeline than people probably assume, right? We would sort of joke, oh, this will happen in 10 years. You're like, no, 6 months, right? But this requires, as Jeff said, this requires sensible regulation, and it also requires a voice inside these institutions.
It's coming. I mean, I'm working on this actively in the background in various projects. It's coming at you much faster than you understand. If we, you see me with that adoption curve chart all the time, just trying to get people don't really yet understand what that means, right? We're 300 million active users worldwide in digital assets. It means it gets to, essentially, it's growing at 185%. We get to 600 million plus, call it 750 million by the end of this year. Even if we have a slow year, we get to 500 million. The year after, it's 1 billion. The year after that, it's 2 billion. The year after that, it's 4 billion, right? So the speed of which this is coming, people do not comprehend. And the movement, I think, from the $2 trillion asset class today to the $200 trillion asset class that Jeff's talking about is by the end of the decade. It's the fastest growth of any asset class in all history, the fastest adoption of technology in all history, and it's going to be the fastest generation of wealth in all history. That's what's going on. And we all get lost in the day-to-day of the ups and downs of the market and, shouting at each other over Cardano versus, fucking whatever. And it's just all noise. It's just noise because you've got the biggest, fastest secular trend any of us will ever live through. And we can participate. We don't have to be VCs. We don't have to be the rich dude who's got the access. You just need to get involved. and also keep a very open mind. As you know, Jeff and I have been trying to explain here, this is not about Bitcoin. It's not about Ethereum. It's about a complete and total business model revolution. So it's not just financial, it's everything. And once people open their minds to it, you'll see how big this is.
Yeah, I mean, I was in a big meeting with about 12 people at a huge endowment. I was at a big meeting with a bunch of people at an endowment recently, and one of the people who came in very skeptical at the end of the meeting said, I came in thinking about the word equity means.
Go ahead.
You lose me? Sorry, my bad.
Jeff.
Yeah, we lost you. Go ahead. Yeah. We got some good freeze poses from Jeff, though, there.
Yeah.
Apologies. I got to jump here in a minute anyway, but I'll leave it as what some of these.
Every time you get to the punchline, Jeff, you go. We've lost
right
it.
there. And then there were two, and I know, Raoul, you have to go as well. That last 30, 40 minutes was really compelling because I think, as you sort of said, we get very bogged down in what's happening today and the macro situation and what will happen in the war and hawkish Fed and et cetera. And it's literally irrelevant.
It really is. Unless you're a trader. And fine, some people are traders, and that's okay too. You know, it gives everybody the opportunity, but just don't lose sight of, if you take the adoption chart, when I always talk about living in the future, what does that mean? What does it mean to have 3 or 4 billion people in 6 years' time? Well, it means a complete change in everything we're doing. And that's not Bitcoin and Ethereum accruing all the value. That is what Jeff's talking about. That's social tokens, community tokens, NFTs, and that's putting up all of the other assets on chain as well. So it's a lot. There's a lot about to happen.
I know we have to go, but one more question. Can the technology actually scale to that level of adoption?
Again, people have a tendency to look at today. Well, we can't do that speed. You know,
of course, we can.
No, but everyone's going to build it. Right? That's how it works. Everyone does this all the time. They always take the present and say, well, that's impossible. But the present is not static because every day is a new day and every day things move forwards. So if you were to extrapolate the rate of change of development within these protocols, well, they're moving at lightning speed. You know, lightning being a classic example. It didn't exist 2 years ago, and now it exists.
Right.
So who the hell? What is going to come out of this space? Well, soon you'll be able to have massive video file on blockchain. You know, these huge dense files. You know, all data, all scientific research, all of this onto blockchain because the technology will allow it to happen.
Well, God forbid any of us being the guy who's saying that the internet will be no bigger than the fax machine. Should never scale. Can't happen. Right? Or not imagining that we would ever be streaming video or audio, right?
Exactly
And
right.
every example in history of technology evolving has been at this point where people said it couldn't happen and it couldn't scale. Raoul, thank you so much for joining. I really appreciate you popping in. I know you're like the busiest man on the planet, so we really do appreciate it. Thank you so much.
Good to see you, my friend. Take care.
Oh, okay, guys, that was wow. So here's what's going to happen. I'm going to cut that into a podcast, or have Mike, you're going to cut that into a podcast. There were too many incredible gems and statements there for me to even process it as it was happening. But I think that was, listen, I watch a lot of content. This has nothing to do with me. I think Jeff and Raoul there in the last 30 minutes presented a vision for this space and the evolution of digital assets, we'll call it, that I've actually never really seen on that level before. Amazing to get minds like that together and just sit back and shut up and listen to them. Really, really, really incredible. I'm almost speechless. That was really, really impactful. I found that just to be amazing. So guys, yeah, these Thursdays are just blowing my mind. That was amazing. We will continue to bring these guests back. Of course, I will be back tomorrow morning at 9:30 a.m. Eastern Standard Time. And you'll probably be like, I don't know, really disappointed because, you know, it'll be like me think we might have some guests tomorrow, though. But it'll be, you'll have to listen to my bad jokes while these guys are talking about Disney coin and $200 trillion market caps. So guys, listen, we're going to cut this into a podcast. Then we'll get all the best bits. It'll be on Spotify, Apple, and everything. But I'll ask you, listen, I'm trying to do everything for free right now. Just share it. Send it to a friend. Send it to a friend. We all have a friend who has been shitting on crypto for years and has no vision or understanding of what's possible. Send them the last 30 minutes of that. Just say, hey, tune in and watch the last 30 minutes, right? Because maybe I'm way too far down this rabbit hole, but in my mind, you couldn't listen to that and not be excited or compelled to participate in this space. And if you joined too late, rewind. What will Disney coin do to the Mongoose coin with the Cobra coin? All right. Even if you don't have any friends, share it with your imaginary friend, Alon Gate. You're a little unicorn that sleeps next to you at night. Anywho, guys, that's all I got. And now I'm going to record a podcast with Jameson Lopp, which is fucking awesome. My life is great. It's great. Having a great time. Love you guys. We will be back tomorrow. Peace.